Hi ladies and gentlemen, this is Game of Trades and this is going to be a technical analysis of the S&P 500. So far we have a red day here on the S&P 500. To put the situation into perspective, we were trading within this range right here between a strong support level right here and a strong resistance level. We were bouncing up and down and we finally broke out of this range and we started trading for the past few days within this gap range right here. And in the last video, we talked about this resistance level, the top of the gap being a strong resistance level. So if you're looking for a long trade to the all-time highs, which would be the next target for a long trade, you're looking for a breakout above this tiny trading range right here. But so far we are red. We're starting to break down below this trading range. We've already taken a dip below the trading range. Is this a false breakdown, which would lead to a short squeeze for that long trade? Or is this the real deal, which would actually trigger a trade down back to the bottom of the trading range, possibly to the 3,000 point level right here? So that's what we're going to cover in this video. And if you stick around to the end of the video, we're going to take a look at the parabolic trends that we've seen in certain parts of the stock market and what that means exactly for the future of investing in the stock market. Without further ado, let's get right into it. So the first thing we're going to take a look at is the put-call ratio. This is definitely something we've talked about a lot on the channel. It's the ratio of puts to calls that are being made on the S&P 500 at a given moment. And so we've made three major trades based on this put-call ratio recently. We made one right here at this extreme level. This corresponded to the March low. And so you can see when everyone was betting that the markets were going to go lower, well, the markets actually reversed. And we did the exact same thing back here at the top. We had a very extreme put-call ratio reading right here. We shorted the markets and we had a nice correction. And currently we're sitting right here at another extreme reading. This is the 0.4 level on the put-call ratio. This could definitely lead to some more downside, at least in the short term, to shake out some of the calls that are being made on the market. Now again, take this with a grain of salt. No indicator is perfect. No indicator will be 100%. There are moments where the put-call ratio stays low and at extremes for a long time, and the S&P 500 just keeps on going up. You do need to keep your stop losses and be open to being wrong. Make sure to like and subscribe if you haven't already. It really helps getting the videos out to more people. So if you appreciate the content, don't hesitate to do so. Now back to the S&P 500. I have something very interesting to show you on the hourly chart. We're starting to get some divergences. So this is the hourly chart and you can see we have a divergence on the RSI. This is the price making a higher high right here at the top and the RSI making a lower high. And that indicates a potential trend change. And so far that has actually triggered a nice drop. And you can see the last time we had RSI divergence was right here. We made a series of higher highs in the markets here, and the RSI, you can see, was making lower highs right up until this point. And so had you traded these divergences combined with the extreme put-call ratio after the huge run up, you would have made a huge profit to the downside in just a single day, and that's exactly what we managed to do on the channel. Now I do have one problem with this breakdown right now, is that we're currently reversing and getting back into that trading range, and that would mean that this is a false breakdown and that could very well trigger a short squeeze and break out above this level. So if you start seeing big impulsive green candles up and past this resistance level, that's going to create some big moves to the upside here because the shorts are going to have to cover. But again, for now we have to trade it as it is. I'm going to clear the chart. So far this is just a breakdown, a back test of the support level that we broke right here. And if we reverse now, that provides a nice shorting opportunity for some targets to the downside. I'm going to give you guys some targets. This level right here, the 3,100 point level right here, is a good first target. Next target is going to be this level, 3067. And then a final target would be those lows right here, 3000 point level. So this could very well be a divergence induced and put call ratio extreme correction. And so you'd get a nice move to the downside, potentially down to this level, but not necessarily. I do expect that we'll bounce off one of these levels, and I'm going to be explaining exactly why. We're going to head on to the market sentiment, which is something we talked about briefly in the last video. You can see the market sentiment is clearly bearish, and so that may seem confusing. We've got put call ratio, which is very low, which means people are betting that the market is going to go higher, but we've got a market sentiment which is bearish. What you have to understand is that the market sentiment looks out for the next 6 months, and so this has much longer term implications than the put call ratio, which is actually for the next few days. So a low put call ratio reading means the market is overbought in the short term, but when the bearish sentiment is still very high, that means the rally might still have some fuel left. Rallies typically don't end when bearish sentiment is still high. So going back to the S&P 500, for me, these targets are buying opportunities on the S&P 500. And of course, this would be a longer term trend. And so of course I would dollar cost average down along the way down, and then put a solid stop loss below here. Because if we start breaking below this level right here, this 3000 point level, this is very bad news for the markets, and we're likely to see much more selling on a break below that level. So now that we've got the technicals and the trades out of the way, we can take a look at some individual stocks, starting by Apple. This is the chart of the stock Apple, and you can see it's starting to go parabolic. It's really starting to get some big gains off the March lows. We had an 80% gain off the March lows. These are huge numbers. We're really starting to see greed come back into the markets. These are not normal gains for the stock market. Stocks are behaving in a way that I've never seen in my trading career. I think we're really starting to get towards the end of that debt cycle, of that business cycle, where we see huge speculation in the markets, such as these moves. We also have Tesla that is going absolutely crazy. Yes, Tesla is a disruptive stock, but the price is highly leveraged and highly speculated. When you start to see these kinds of moves in the markets, and I know some of you are new to the stock market, you should not think that this is normal. And I think this is a big problem with what's going on right now. This is not good for the stock market. This is very bad. It's making the stock market way overvalued and makes investing into stocks very risky. Now, I've described my vision into the stock market into the next few weeks. I think prices can still power on through. These stocks are still on a heavy uptrend and pulling the rest of the stock market up with them. If we go back to the S&P 500, we're going to see the momentum is still to the upside. We had an MACD weekly crossover right here around at this level. This is bullish momentum. There's nothing you can say against that. We had the same crossover right here, same crossover right here in 2016. These all led to big moves. Now, obviously, a move down is very possible. I think the markets are very fragile right now. And as soon as the liquidity starts to slow down, I think we're going to see big moves down in the stock market. Now, for next week, we have to pay attention to the earnings of the banks. They're going to be reporting earnings next week. It's going to be very interesting to see those earnings because by all logic, banks have been losing a lot of money with this recent shutdown. People are not paying their loans. People are not paying back the debt they have. And so banks are going to be running at a deficit. It would really not surprise me if some of those banks go bankrupt within the next few weeks. And I think that could really trigger some bigger moves down in the stock market again, perhaps later into the summer, perhaps September. Now, that's about all I wanted to cover in this video. I hope you guys enjoyed. If you did, make sure to drop a like and subscribe if you haven't already. In the meantime, good luck on your trading and see you next time.